Welcome to the Investors Guide Budget Special. This is a big show. We heard the budget announcement this morning from our Finance Minister. It was important on so many different levels. But on this show, we only focus on you. How does it matter to you? What does this mean for your investments and your savings, and what you should do now? Remember, this is a completely live show for the next 1 hour. So if you have any question at all about the budget or about anything you hear on the show, tweet in your question right now. You can reach me at Faye D'Souza, or you can tweet in at ET Now Live. Of course, on the show, I have a wonderful panel of guests who've been with me now for 5 straight years. So it's almost tradition that I spend Budget Day with them, and I'm not complaining because they're the best in the business. A quick round of introductions. Shailesh Haribhakti, our tax expert. Anuj Puri, he's the country head and chairman of JLL. Pankaj Razdan now heads an insurance company. He's also the deputy CEO of Aditya Birla Financial Services. Every week for the last 5 years, Narendra, CEO of Value Research, has been helping us with our investments. He now joins us from our Delhi studio. Before we go any further, here's a list of everything that was said in today's budget that matters to you.
The Union Budget of 2014 announced many small sops for savers.
I propose to increase the personal income tax exemption limit by Rs 50,000.
The biggest takeaway for individual taxpayers is the increased limit of exemption for investments under Section 80C of the Income Tax Act to 1.5 lakh rupees. That is a total saving between 5,000 to 15,000 rupees depending on your tax bracket. The basic tax exemption limit for individual taxpayers was raised to 2.5 lakh for those below 60 years and to 3 lakh rupees for those above 60. Now, if you prefer to invest in the Public Provident Fund, your annual limit has been increased from 1 lakh to 1.5 lakh rupees. Home buyers have reason to cheer, as the interest deduction on home loans has been hiked to 2 lakh rupees a year.
This will streamline tax administration.
The Finance Minister has also allowed for mutual fund-linked retirement plans to have the same tax treatment as the NPS. This means you can choose to invest your pension money, invested entirely in equity and managed by a private fund manager. Investing became slightly easier too, with the announcement of uniform KYC across all investments.
The government is committed to an endeavour to have housing for all by 2022.
Working towards this government's target of one home for every family by 2022, many SOPs were announced to give the much-needed push to housing, especially in the low-cost housing sector. The government intends to provide necessary incentives for production of real estate and infrastructure investment trusts. This will boost the liquidity in the real estate sector. And in a move that will come as a big blow to the mutual fund industry, the Finance Minister has increased long-term capital gains tax on debt mutual funds from 10% to 20%, while the holding period has increased from 12 months to 36 months.
All right, so we're going to go straight to our guests here, and I want very quickly one key takeaway from each of you that you thought mattered the most to the retail investor in this budget. Shailesh, I will start with you. What is the key takeaway that you thought mattered the most?
I think it is the PPF enhancement by 50,000 rupees. That gives a very large additional tax-free income, as well as the full 80C exemption can be utilized with just the PPF investment. So I think that's the big takeaway for the small investor.
Well, Anuj, everything you had on your wish list was almost announced, so you're a happy man. What was the most important? REITs? Makes you happy?
Ear-to-ear smile, absolutely. You know, for the last 4 years, I've been here at your show, and no word of real estate was ever spoken by the Finance Minister. This time, it looked like a real estate bill only in the first half an hour. There was like real estate investment trust, private equity, you know, further liberalization from 50,000 square meters to 20,000, and a huge amount of focus on affordable housing and the infrastructure. So I think I have a lot to say, but I would say for the consumer, affordable housing was a great focus.
So I just want to help our viewers understand REITs right now. Does this mean, like I would invest a minimum of 500 rupees in a mutual fund, can I now invest in real estate in that manner because I don't have 1 crore rupees to buy a home in Mumbai?
You're absolutely right. You're going to be able to buy units on the stock market and there is going to be regular dividend income that is going to be distributed to the retail investor, and hence by virtue of that you're going to be able to play in the real estate market and in the growth of the realty sector by investing through the retail sector. You could have done that before as well, but that was really on the listed companies, stocks of developers. Today you'll be able to do it through sector which will provide you regular dividend income.
All right. Pankaj, what makes you happiest right now? Is it the fact that mutual funds will now be allowed to manage pension money?
So I think it's a sum of all of them. But to me, I think one of the things which is a big differentiator, I'd say this whole budget has been moved to a lot of structural changes. It's not cyclical, whether it's for giving extra exemption, leaving money on the table, or housing or mutual fund managed. But to me, to get to a retail investor with a single KYC, to get to a single investor with a single demat account, actually it removes all the hassles. Imagine if somebody has to go to 5 mutual funds, 3 insurance, 2 brokerage, 1 REIT, he has to open some 15, 20 accounts, and to remove that hassle.
And those forms are awful.
Awful forms. I don't fill myself, though I have a secretary. I mean, even signing them makes me a very painful at time. And just to have that one single window for both opening an account and also having a one single KYC, I think that removes a lot of administrative hassle. So that's what I say. I think this whole budget, not only from this perspective, even if discussed going forward, there are a lot of structural changes in this budget, which are very positive for retail investors.
All right, quick explanation for our viewers who are watching. What this basically means is you start a mutual fund, you fill out your KYC, you give them your address proof, your ID proof, your age proof. You only have to do it once. You will not have to do it every time you make a fresh investment. Let me bring in Narendra Kumar. Narendra, when you listened to the budget this morning, what did you take away from it? What do you think is the most important thing you heard?
In fact, the most important thing which came in the budget was something which I did not hear. Unfortunately, it was conspicuous by its absence in the budget speech, which was quite significant. You know, the biggest problem of this, I completely agree with Pankaj. In fact, it is much more than what you are stating. In fact, what the finance minister has said about KYC is that for the whole of financial sector, we will just have one KYC, which means that for investing in mutual fund, if you are making, for which investing through bank is a mandatory requirement, which means that if you have a bank account, which is compulsory for if you are investing in mutual fund, which means you effectively don't need KYC. So it effectively means that if you have a bank account, or if your KYC has been done once, it will be acknowledged as a KYC, and there will be an institutional mechanism to recognize that and acknowledge it. I don't know how, there could be devil in the detail, but at the face of it, it looks revolutionary. I think it has been one of the biggest impediment to democratize investments in this country. That apart, what I was referring to is something which I did not hear in the budget, which is enabling mutual fund retirement plan, giving it the equal status of the pension fund. So effectively, and the structure that was proposed by SEBI, and I have been partially part of it, so I can say that effectively overnight we will have the biggest problem that our market face is that investors come in equity at the inopportune time. There is no institutional mechanism to attract long-term money. There is absolutely no incentive, and there is no mechanism to actually hold them. So this overnight creates something equivalent of a 401k plan in the US, which democratized equity investments in that country, and that was an inflection point in the history of the US market. So from I look at it like that. Retirement plan in mutual fund and the kind of structures stipulated by or suggested by SEBI means that overnight we will have options. All mutual funds today, they come in 2 plans, and we will have the 3rd plan, which will be retirement plan. Investors can invest. They cannot take the money out till their retirement, but that money will have portability to any other retirement plan of any other company. So your money will be you can move your money, but you can't take your money out, and it will have a relatively lower expense and long-term money, which has been virtually absent. People claim with great pride that the average life of investment in mutual fund is something like 28 months or 32 months, which is a shame. Nobody has been able to we have our market which has given a return of something like 18, 20, 22% of all the funds which have been in existence for 15, 20 years. But no investors have experienced it.
Take it from here very quickly. So what we're talking about, again, to our viewers who are listening at home, is a mutual fund where you'll be able to put your money in. It will lock you in until 60, but you will be able to move from fund to fund. If you're unhappy with the way your fund is being managed, you can move your money to another fund, but it will allow you to have your money privately managed and invested in equity. Pankaj, does that make you happy?
Absolutely. Absolutely. This country needed this kind of money in the absence of social security. I think this is the best way to go and attract long-term saving from customer point of view. And I think this is the smartest way government has played to get savings into investments. Otherwise, your savings remain always savings.
You know, there was this other thing that came up that sort of got skirted by, nobody noticed it. The EPFO will have now one unique account. There's portability. And this is a problem that so many of us have.
Absolutely.
You change jobs. You don't know what happens to your PF.
Yeah.
It's so difficult to get it transferred. Sometimes people just let it go. Yeah. And that's so disappointing. Shailesh, do you think this is big if they manage to execute it?
It's very big. I had gone public to say that this single KYC and this single demat account are the biggest revolutionary changes, because it will have so many great effects. It will help you to manage your wealth. It will help analytics on how people are saving to be done more effectively. People will be able to manage their money right through till retirement. Wealth managers will have a better idea of what is the underlying asset allocation. So from every perspective, this will, and it will reduce fraud. It will reduce the number of times that manipulations were happening. Those will all be a thing of the past.
All right, so obviously the thread that was interesting in this entire budget is household savings moving towards long-term investments. That's what the finance minister was trying to do. I'm going to take a few questions from our audience members. Does anybody have a question here? You do? Go ahead.
There are a lot of positive definitely for capital markets, but I think there is tremendous overlap between mutual fund versus insurance. You have rightly mentioned that increasing ATC limit from 1 lakh to 1,50,000 plus PPF is positive. Yeah. But what about insurance is a part of that? Mutual fund ELSS is a part of that. Why not have a separate window for ELSS? Second question is, we have seen numerous examples of mis-selling in insurance sector. Second issue is, what about debt mutual fund? We say that equity is for long term. It's all about time in the market rather than timing the market. You are increasing long-term capital gains for debt mutual fund to 3 years, and you're keeping equity at the same. All right? In fact, real estate was expecting from 3 years to 1 year, but reverse has happened. I mean, this is something confusing for me.
All right, so let's take it piece by piece.
Yeah, too many questions.
He's done the whole budget in one question.
Go on, Shailesh.
So, I'll address the issue of debt mutual funds. What has happened is that you are given a window until 31st March of 2015 to decide whether you want to stay long-term in a 36-month long-term debt instrument, or you want to take the money that you have invested so far out, so that you're not subjected to the tax in a retrospective way. So that has been done to put the level playing field between a bank deposit and a debt mutual fund. So the 10 to 20% is the cap gains, and the dividend distribution tax, or the income distribution tax, has been levied. So there is a bit of a equalization between the bank deposit and the debt mutual fund. That is what is sought to be done.
Pankaj, I want to come to you with two of his questions. One is, he said mis-selling in insurance, and I saw you twitch a little bit. Also, when that happens in April next year, do you expect redemption pressure then on these debt mutual funds, because people want to take their money out before they get taxed?
I don't think so. I think I've seen in the past number of such regulatory changes happen and people start adjusting to it. I think it's a very positive move. If you look at negative, start looking negative. Why should somebody be putting money in debt mutual fund only for 1 year? When you can put money in PPF, in small savings for 5, 10, 15 years, in bank deposit for 5 and 10 years, why should we be doing that for 1 year in debt mutual fund? The whole idea is to go and start putting savings on a long-term investment point of view. And just to answer his second question, it's not only debt versus equity. It's a question of an asset allocation. Every individual has a different asset allocation. Some wants to put more in debt, some wants to put more in equity, depending upon what kind of outcome you want to reach, what kind of a risk appetite you have, and what kind of a holding tenure you have in that. So I think that's a question. It's not a question of differentiating between equity and debt. It's coming to another question of mis-selling. I think mis-selling is a phenomena which has been existing in capital market as a whole. Maybe insurance has got a little more visible.
It does, yeah.
It has got more visibility for a reason, because it's a very large retail business and it impacts the savings of this thing, and it's a very unfortunate part. But I think you have to look at every such thing also have got a positive side to it, because the way the changes have happened at 3 levels, the changes which has happened at the regulatory level, the change which has happened at the government level, the change which is happening at the industry level, regulatory level, the product design have been completely made in favor of a customer right now. Right? So today the power...
I want to quickly interrupt you here, and I'm going to ask a question that everybody's thinking at this point. And unfortunately, it's not just your company, but you're the only one here. Things change, but what happens to those of us who bought insurance policies 3 years ago, 4 years ago? We're now holding these policies while you tell us that there is a better version in the market. What do we do with the policies we're holding right now, which are possibly, in most cases, in lower value than the amount I invested?
So I think there are different kinds of policies. If there are policies which are saving plus protection, I don't think so it makes sense for you to change, because anytime you want to change that, you have paid the amount of charges you pay, it doesn't make a sense for you to go and switch over to another scheme. But if it's a pure protection policy, I can say that the many insurance companies have come back with new protection schemes. So when somewhere they were charging you $100, today they charge you $90. If that's the case, then you can always switch. All insurance companies will be happy to do that, because they are passing on to you now, because they also have got those benefits right now.
All right, I want to bring Narendra here. Narendra, Pankaj just told us that the idea is to invest long-term money in equity, but you've given advice on this show where you said that, okay, if you have some cash, you don't know when you might need it. For example, if I'm looking for a house, I don't know when I'm going to find that house, when I'm going to enter that deal. Anuj is nodding. I'm going to need that down payment. Put it in a debt mutual fund, because then you'll be able to pull it out in 2 days. That may not be applicable anymore. So what happens to that short-term money?
No, I don't think, there were many reasons why investors invested in debt mutual fund. One, less volatile asset class per se. And today mutual funds offer you a great choice. You have investments, you have funds which are suitable for a couple of days. There are investments which are suitable for a couple of week time frame. There are investments which are suitable for a couple of months, and then there are ones which are very opportunistic plays, the income fund, the dynamic bond fund, or if you want no credit. So mutual funds offer you a full range, and you can choose from that. That apart, tax efficiency bit has gone away. Because there was a very clear difference. If you invested in if you made a deposit, the return that you derive is taxable because interest income is taxable. This debt fund for your holding of over 1 year were able to convert that taxable income into capital gains, and because capital gains is treated differently, and the rule was very straightforward, 10% or 20% with indexation. Given the inflation rate and the cost inflation index, it was virtually tax-free return if you held it for over 1 year. Now, this tax arbitrage has been done away with. But that does not really take away all the merits of this product, because money for few days, money for few months, money at call, and investment on tap, that is something which no deposit offers. That too, optimized return, because this is mutual fund is disintermediation. When you make your money, when you make a deposit, banks take all the risk and they get the returns, and they actually they also assume the risk. In this case, you are assuming the risk, you are getting the transparent liquid mechanism of deriving that return directly. So I think they still will be relevant. They are relatively less attractive, and this was a tax arbitrage or a window which was made available, and it has lasted well beyond its relevance.
All right, so it was good when it lasted, but it's no longer available. You have a question? Go ahead.
My name is Malav, and I want to ask that we as young investors, when the government says we are reintroducing Kisan Vikas Patra, so versus the rich bond, so what is it a better choice for us as young investors? Should we go for KVP, or should we go to the rich bonds, or should we go for some other infrastructure bonds?
Well, the question is, what do you want to invest that money for? How long are you putting it away for? And this is something that all of our viewers should realize. It's not just about randomly picking an investment. What is the goal? How long do you want to put this money away for? Then you decide what investment you're going to put it in. So if you are a young man, how long are you willing to part with this money for?
So 3 to 5 years.
Only 3 to 5 years? We just had this whole conversation about long-term investments.
Yeah,
I won't bully you. 3 to 5 years. Pankaj, where should he put that money?
So, I don't know, don't say that I'm very biased because I come from capital market. I think the best way for anybody is that you have a professional fund management and you get it at 1%, 1.5%. Why waste your mind and money anywhere else? Go to a good mutual fund, go to a good insurance company, you get everything what you want. Narendra just talked about it. You get a diversified portfolio, you get a great fund management skill, you get a various asset classes. You get everything at 1%. Don't bother. Just put it in mutual fund insurance.
No, I mean, but it's not that obvious.
Sorry, I just wanted to do for myself. For rest of Kisan Vikas Patra and everything, I'll let him talk about it.
So Kisan Vikas Patra is certainly an option. because you'll have a long-term capital gain. It will certainly be more than 3-year tenure, so it will be a long-term cap gain. And that is taxed at a concessional rate, as we are aware. Also depends on what your income level is, also depends on how long your saving horizon is. So if all of that matches, then you will get a net of tax return, perhaps, which is advantageous in a Kisan Vikas Patra. And you will have to do the calculations when you are about to make the investment to make sure that you're doing the right thing. And it is certainly something that should enter your asset allocation thinking.
Right, but you have to take the help of a financial planner and look at all of your assets and not just pick one because it was announced in the budget. Anuj, just so our viewers can understand, what sort of returns can we expect from REITs when they are made available to us?
So it will be between 8 to 10% as your dividend that you're going to get. And then as the assets switch over, the capital appreciation in that could be 3 to 4% per annum. So you could actually get up to 12, 13%. As a return on the REIT investment that you've made.
Pankaj, from the market that we're looking at right now, and it's been quite a market this year, would you say REITs would do better than an average equity mutual fund? Because 12% annualized is what we conservatively expect from a mutual fund.
I mean, I always remain with one principle. I think it depends upon what's your objective of doing it. And if your objective and your goal is long term, you still need to go and put part of the asset allocation in equity. If you're looking at low risk and comparable asset class with income plus appreciation, I think REIT is one of the phenomenal option to do that.
It is.
Because at the end of the day, the same platform, whether it's mutual fund or private asset managers, they're going to offer all these things, all the products. So I think each one has got his own life, each one has got his own advantage in the portfolio. It all depends upon an asset allocation and an individual's clarity. What we are expecting out of it. But as a product, I would say it's a very important product to be in the part of the portfolio.
What will happen is that the financial advisor's role will become very crucial.
More relevant now.
Very relevant.
Very relevant.
Very relevant.
All right, so remember, like you would have a family doctor, you have to have a financial advisor who will tell you what you should be buying and how you should be investing your money. Quick break. When we come back, we'll talk more about asset allocation and how the budget impacts you. Don't go anywhere. Welcome back. You're watching the Investor's Guide Budget Special on ET Now. Thank you so much for staying with us. Like I told you, you can tweet in a question if you have. Rohit Dhyani has tweeted in. He says, if the ATC limit has been increased, please tell me how to invest that extra money. We're going to take his question. We're going to take a few more questions here on the show. You have a question? Go ahead.
My question is to Pankaj Razdan sir. A new form of NSC have been introduced with insurance cover. So is it expected that the rate of interest on those NSCs will be reduced? Just to
all right, so he says that, and we know this was an announcement that came in from the budget where the finance minister said the national savings certificate will come with a small life cover as well. He wants to know who pays for that life cover. If I'm paying for that life cover, then my net interest on that product will come down. Do you know what the answer to that question is?
So my sense is somebody has to pay, and it will be only a customer. So I have not read the finer details. Nobody else is going to pay than the person who is buying it. But I think still it's a good stuff.
No question.
The price what you're going to pay is much lower than what you're going to get out of it.
All right. Narendra, I'm going to bring you in here for the two questions. One was increased ATC limit. This is what a lot of our viewers are going to be asking. What do we do with the extra 50,000 rupees? And of course, there are these products that combine investments and insurance. How do we decide if that's enough of an insurance cover? How do we decide how much insurance we need?
It is a different thing for different people. If you are unable to save anything, and if you are young, you have more than 5-10 years to invest. I think ATC should be something which you should be using to the hilt. And for those time frame, I think ELSS presents the best opportunity. If you are likely to retire in 3, 4, 5 years, and you want to play it conservatively, then surely consider the fixed income options. NSC's National Savings Certificate is one of them. And of course, when it gets combined with, if it starts offering some meaningful insurance coverage, I hope that, it has a low cost and it is not a substantial compromise. We have seen that the pricing structure or the interest rate on these small savings instruments offered by National Savings Organization, it has found a method in the last couple of years. Every year in the month of April, the rates are revised. And it is reasonably linked to the, not the cost inflation index, but the prevailing interest rate. And there is some internal formula which is followed, and it gets revised annually. So you are unlikely to get locked into some rates they change now. And that is, and of course, buying a group insurance or combining it with any saving product is relatively cheaper, but it is unlikely to serve. Don't look at it as a solution for your insurance need. That you need to address it very independently, and I think insurance comes well ahead of ability to save or being able to save or invest for the long term. Because and look at insurance as an expenditure, look at it as a buying protection for your family, and that gets you the financial security. So prioritize things. For long term, look at ELSS. For short term, look at the fixed income avenues. Hybrids, actually, they from a the way I look at it, they are neither here nor there, and it becomes very difficult to evaluate them, to analyze them, and you get the worst of all. So they are best avoidable. And what I'm looking at, these retirement plans, if they become mainstream, then this could be one very significant thing, because this is going to be a tax break over and above 80C, because this is under section 80CCD, which does not come under the ambit of 80C, because so far we are used to something else. This could be quite revolutionary.
All right, so if that does happen and you do get an additional benefit over and above 80CCD, you'll find out on this show. We'll be here to tell you. One of the things I was most disappointed about in this budget, no mention of health insurance. The tax deduction that we have right now when we buy health insurance for our senior citizens' parents, I thought that tax deduction really needed to be increased, because as it stands at this point, it does not cover the premium. The premium is much higher than the 25,000 rupees that's available to us. Mr. Haribhakti, do you think that there was a need there for more of a push for insurance within the tax breaks?
The directional change that I'm noticing is that he wants to move towards an omnibus exemption. I think the finance minister mentioned in one of his interviews today that once he has more money, he will give a larger overall exemption limit, which is what the DTC also had proposed, that the exemption limit should be at 5 lakhs. Because of the tax to GDP ratio constraint, he could not do it this time. But my own sense is that he's going to leave it free for all of us to decide for ourselves what we should put our money in, whether we should put it in debt or Kisan Vikas Patra or ATC, PPF or whatever. I think all of this will need to go at some point in time. I think it's a 2 or 3 year time frame.
All right. Anuj, I want to ask you this. Of course, we heard so many mentions of corridors in the budget. He talked about a corridor between Bangalore and Chennai. There's a lot of talk about Andhra Pradesh. There's, of course, the Mumbai-Delhi industrial corridor that we're looking at as well. How much of this is going to lead to more land opening up because of infrastructure? Will the prices of homes come down? Will we be able to buy homes in our cities?
I'll answer it in 2 parts. First is really within the existing cities, and the other is within these corridors and the 100 smart cities. So within the existing cities, REITs have actually got 2 benefits. One is for the consumer, so for the retail investor, that they'll be able to now play on the stock market through the realty sector. The second is it'll bring about 50,000 crores of immediate liquidity into the market with the developer community. Today, one of the biggest challenges that we are facing is that there's very little liquidity, and hence the supply of housing isn't that great. If there's 50,000 crores that comes in, the developers then have an ability to really bring in a lot more supply. So that's first thing that is going to happen. Second is that the slum rehab is now a part of the CSR. So you may see more corporates coming into that, and hence that may open up more supply. And the third is that the tax exemption on the home loan for self-occupation, that's increased from 150,000 to now sort of 200,000.
I want to interrupt you. All of that is fantastic.
Yeah.
Is that enough incentive for developers to bring down prices, or will they say that, listen, we've been cash-strapped for this long, we've had to manage all of this debt, this is great for us, but we're not going to bring down the prices for you?
The problem is not that. We've been speaking this for 5 years. It is not going to come down in that section. If I had to come down the prices, they were in dire circumstances now. They would have brought down the prices by now. It is not going to come down. There's one reason, and that's why I'll answer that in part 2. The reason is that your land cost is so high. In a city like Bombay, 80% of the cost of the project is land. How can they play in that 20%? They can bring down 5%, 7%, that's all. So the play is going to be in the part 2, which is these 100 new smart cities. Because I believe that's where your land cost is going to be no more than 20 to 30%. Internationally, that is how it is. the land is no more than 20 to 30%. India, because we did not put up new cities, because we've not put up these corridors and infrastructure, land cost is between 50 to 80%. And that's where the fundamental problem is. Now with these smart cities, I believe that the land cost comes to 20, 30%, you'll have 100% affordable housing. So for the consumer who's watching this, they should be looking at where these 100 smart cities are coming up. And the way that he laid out the contour, that these were satellite townships next to the main cities. And these satellite townships are not pure residential colonies. He was very clear. He said there has to be an economic development, economic activity.
So then are we looking at Gift City in Ahmedabad? Are we looking at Navi Mumbai in Bombay? Yeah. Or a Yelahanka in Bangalore?
Absolutely.
Can I go out and buy right now? Is that a good idea? Should I wait till I hear more?
Or wait until these new 100 smart cities are announced where they are going to be. They could well be one of these, and they are put in Wi-Fi and water and sanitation and others and upgraded. But they could be where it's just barren piece of land. And that's where the smart city comes up. All
right, so wait to hear about where the smart cities are going to come up. I'm going to take a few more questions. You have a question, go ahead.
My question is to Mr. Pankaj. Now, I'm Rahul Zaveri. I'm from Jamnalal Bajaj Institute of Management Studies. So now we have seen that the government has put a lot of emphasis on the energy and the natural gas, the petrol sector. So it is modernizing it. It is going to divest. So what are the investing options that you see in those sectors, in mutual funds as well as in equities, for investors like us?
Pankaj, you knew a question like that would come. Should I be investing in oil and gas? That's the question.
No, I mean, I've also tried 5 years. I'll still continue to try next 5 years more with on the show. Number one, I think you should invest in sector stock specific only when you're an expert on that. If you're not, please go and give it to a fund manager to invest. Coming specifically on one sector, I think it's not only one sector. If you look back today, the overall infrastructure, whatever consists of an infrastructure, has been given a boost in this budget. Whether it was construction, which is through in housing, whether it's as roads, whether it was railways, waterways, airport, and power, which was thing. And power again depends a lot on oil and gas, because some of these power plants are thermal, some are gas fired. So actually, if you really go back, the whole end-to-end infrastructure has been given a boost over here. Like power, they will be all supplied coal, wherever the power is going to get fired, and they have a tax benefit till 2017 if they start supplying power from here. So all good, well-managed company you can buy it, which are rightly priced. So always I say that in market, good or bad market, it's not a cushion company, all good companies, which is at right price. Sometimes you have the best market and you have the worst price. Sometimes you have the worst market and you have the best price to buy it. True. So it depends upon at what time you're buying it. Right? But again, I would just, as a caution, would lead you with, it's interesting to go and find young people to go and look at market. But if you're not an expert, never invest directly in the market.
All right, I have a quick question for you and anybody else who's looking at investing in the market. Today, you got stuck in traffic. You came all the way up to the studio. Did you have time to look at your stocks? No. And if you didn't have time to look at your stocks, you possibly missed an opportunity, which means you should be handing your money to a mutual fund, which can constantly watch that money for you. Narendra, someone asking, obviously people ask us this question all the time, should we be using a specific type of mutual fund, maybe a power sector mutual fund, an infrastructure mutual fund? Is that the way to go?
Yeah, it's a very dangerous way to venture. And unless until you have some specialist understanding or knowledge. So, and what has worked in investing over time is high quality business and a diversified portfolio, which helps you keep check on your anxiety and your own method. If you are investing regularly and accumulating your savings over time, you are able to navigate the market better. And think of anybody who made a lump sum, got attracted to the market recently, was looking at 2% gain on a couple of occasions in a week, and he would have been faced with a 500-point decline few days back, and that can be quite unnerving. So most of the time, I think it's not about for a great fund manager only. It is about accumulating your savings methodically in equity, diversifying well. Because let me just share some statistics. The worst performing fund in the Indian market over the last 15 years has also been able to beat the fixed income return and inflation by a wide margin. So I'm not saying that you should be specifically choosing one, but what I'm saying is that regular investing and having that investment perspective matters so much more than just choosing the great investment. And anything which is concentrated, anything which is not diversified, it actually nullifies the purpose, because most things turn around when you least expect it, and most stuff actually perform when you least expect it. Today investors are getting excited about infrastructure is on the forefront and looks promising, But what has happened to infrastructure funds in the last 4 or 5 years, and we have been answering these questions on the show, are only horror stories. All the big money came into the infrastructure fund only to fall in value. So that's the case for diversification.
All right. So as we keep saying on the show, try and spread your money across the market as far as possible. And of course, the best way to do that is a diversified equity fund. And if you have questions about how to pick a diversified equity fund, you can always reach us. We're here to help you with those questions. A young man over there, you had a question. Go ahead.
Good evening, sir. My name is Suraj. I am from Jamnalal Vijay Institute of Management Studies. My question is, when we talk about investment, there are many options. Inflation index bond is there, provident fund is there, equities are there. Equities are best among all. There to safeguard the investors, there are regulators, SEBI, Forward Market Commission, but there are ambiguous powers between those regulators, overlapping powers. There some reforms are being done from government perspective to actually segregate those powers to particular institution. So what these reforms, how these reforms will impact directly to some of the stocks like MCX, FTIL, these stocks are being directly hampered by the reforms in the capital market.
All right. Shailesh, I want to come to you. This is a super regulator in the financial services market is what has been a demand for a while. When do you think that's going to happen?
Not in a hurry. I think we will continue to have sectoral regulators. But the good news from this budget is that the recommendations of the Financial Sector Legislative Reforms Commission are now going to be implemented. What that will do is it will make all this regulation dependent purely from the point of view of the investor. That big shift will happen as this gets implemented.
I have a very quick question. Now there's a third guy in the mix, and that's the REITs, which will need a regulator of its own. When will we have a real estate regulator? Will it be in the same format as we saw happen in Maharashtra? Do you think it needs to be different?
So on the REITs, it will be the SEBI. So that is what it is. But on the real estate, we've been waiting to really understand how the real estate regulator really comes in. So the way it is being structured currently, that there is a central regulator, and the central regulator has devolved the powers with the state regulator. The central regulator is only giving a model code, whilst it is at the state level that the regulator is going to really work through that model code and then implement the policies for that particular state. So at this moment in time, it is really not a bill. It is not really an act that has come in. But we're hoping, as this government, takes up further shape, that they will bring in a real estate regulator.
Do you think, very quickly before we go into break, that regulator will have enough teeth? Because a lot of the people who write to us say, you know what, I booked a home, I paid all the money, I took the loan, they're not finishing it, they're not handing it over. Sometimes they finish it. Pankaj is smiling again. It's not of the right size. It's not the right specification. The swimming pool is the size of a handkerchief. Where will all of that, where will those problems go to be addressed?
I think it's got shark teeth. It's not even normal teeth. The regulator today has been given shark teeth on two accounts. One, they can blacklist the developer and take the project in the middle. And second is they can imprison the developer. So, these are like far-reaching powers that have been given.
That's excellent news for everyone who's here.
You can repeat one more time. A lot of people must be seeing this.
So it does help me also, fines and blacklists for developers who don't meet those targets. Narendra wants to come in and say something. Narendra, go ahead.
No, this is something, which I think has been a national failure. The biggest investment in an individual's lifetime. And it happens without any accountability. This is where we have all that has been said that one can be blacklisted and one can be put in jail. But actually, we have seen only recently that Competition Commission has come very strongly against some developers. But we know that it is a completely one-sided agreement. Investors have virtually no say, and they have no. The legal structure mandated that each project should be independent, and the builder should not, or the developer should not be able to use it in a fungible way. And there is absolutely some of the basics of consumer protection. When we buy something, there is absolutely no standard. And I think there are very strong vested interest, and the underlying thing is very fishy. So I think this is something which requires a massive reform from the state government, because land, the principal component of this business, is a state subject. and the central regulators, even if they are able to frame a sketchy regulator which will enforce some of the basic consumer protection. I'm not talking of very elaborate consumer protection, but in an agreement, even enforcing that what was promised and what was the basis and what has been delivered, I think even those basic hygiene issues are not being addressed. So I think, and this industry, is so ill-regulated. In fact, it's quite funny when we come across any instance of a bad treatment of a consumer here.
All right, I'm going to have to take a very quick break. So this is interesting. We talk about mis-selling of insurance and mutual funds, but the minimum investment is 500 rupees. But real estate, we're talking upwards of 1 crore, 2 crore, 3 crore rupees. There's no accountability. There's no regulator. That is the need of the hour. We're going to come back and talk more about it after this break. Don't go anywhere. Welcome back. You're watching Investors Guide, the budget special. We're talking about how this morning's union budget announcement affects your money. Another thing that was missing from this budget entirely was a mention of inflation. After all of the talk we've had about how it's one of the biggest problems that we're facing, there was no mention of inflation. And something that really bothered me, no mention of inflation-indexed bonds, which we heard from last year's budget. They were launched. They were imperfect, like most things launched by our government. They needed to be relooked at, but no mention of them at all. Shailesh, should they have said something about inflation-indexed bonds?
See, I think that is written all over the budget. The way that the risk management has been done, if you like, of putting in bits and pieces in various parts to bring it together, I think there's a movement to go right. Let things be decided by the marketplace. Now, when that happens, inflation will be tamed. That's the expectation. I think the Reserve Bank governor also today went on record to say that as soon as he sees the inflation coming down, the interest rates will drop to create the virtuous circle. My own sense is that as we allow this budget to work its way through, we will find inflation coming down, particularly food inflation, because the whole focus is on making sure that there's free movement and there's no hoarding.
Pankaj, I want to bring you in here very quickly and ask you a macro question. Now, for everybody watching at home, the government has given us tax breaks that even if I'm in the highest tax bracket, it saves me 35,000 rupees a year. In the lowest tax bracket, it saves me about 15,000 rupees a year. Is that enough to make up for what inflation is going to do to my household budget over the next 6 to 8 months?
This is fair. You're assuming that inflation is going to run up. So if it's going to run up, then it's not going to.
If it stays the same.
Yeah, so if it's going to come down, it's going to be different. So my first disappointment, if you ask me, was that he didn't speak enough on inflation. But if you look at the core of this budget, that's why I kept on saying that it's a very structural change budget. He wants to create a sustainable growth by high growth and low inflation. He should have spoken a little bit more. But you go back, the biggest bold statement he made, it's like any company, if a CEO changes, a new CEO comes in and the earlier CEO has done a bad job, so the company is bad, you want to rewrite the balance sheet, it happens in everywhere. I expected that he would come back and say fiscal deficit is going to be very high because I'm getting an economy not in a good shape. To come back and say I'm going to do a fiscal deficit at 4.1 itself actually gives you a signal if he's able to manage that. And it looks like the math doesn't add right now. But if he's able to do 4.1%, you don't need to worry of inflation. Because if a deficit is lower, your inflation automatically comes down. Yeah. The biggest driver of inflation is a deficit. So actually, if you look at the heart of his budget, is high growth with low inflation. Though he didn't talk much about it.
Also, no mention again of disinvestment of PSU companies.
So I was coming back. He would come back over there. So if you really come back again, if you look at on that, he did two different things. Number one, he didn't talk about it. If a market is like this, 63,000 crores, I mean, you have 3 QIPs of 5,000 crores right now. If a market continues, if the sentiments are bullish, if we see a growth, and if we are today seeing policies which are very, very, as I say, structural changes policies, whether it's in infrastructure or power, everywhere else. Second, very clearly, he's talking about inflation on two counts. He's creating as much as demand, he's creating a supply for that. Whether it's through corridors building up, whether through manufacturing capability building up, services building up. So I think that itself is a very, very big thing. So to me, it is an important issue, but his whole bold line statement of 4.1 fiscal deficit answers everything out. So
I'm running out of time very quickly. The young lady had a question. Very quick.
I have a question for Mr. Rajdan. Given that most of us are entering the workforce about a year from now, don't you think we can take on more risk than a mutual fund? And if not, could you suggest a few mutual funds that we could invest in, given this budget and being students?
I think I would love it. You should definitely take risk because you have got many years to go from here. And risk is actually not investing in a right asset. So if you invest even in equity or any mutual fund you pick up, you take up any of the top 5, 6, 7. I don't want to say that take my Birla mutual fund only.
But you said it nevertheless.
I just repeated so she should know I come from a Birla family. But nevertheless, there are so many other good fund houses you can do it. And yes, certainly if you're entering right now, I always encourage people to put money for a longer duration. Till the time you're an expert, you learn yourself well, don't put money directly in the market. Mutual fund are the best asset to do that.
All right,
Which one to buy? Your choice.
All right, so I'm running out of time, but before we go, I want one piece of investment advice from each of you, Narendra included. Shailesh, one piece of investment advice you'd like everybody to take home with them today.
Review your investments every 3 months because the scene is changing so dramatically. Inflation may change, deficit may change, policies may change. So review every 3 months.
Anuj, any idea? Is that idea Hyderabad by any chance?
Keep money aside for REITs. So don't invest everything in equity or mutual fund. Keep aside money for REITs. It's going to be 6 to 9 months before the REITs really come in force. And I would say that's going to be a great sector to get invested in and be able to get regular dividend income.
What kind of risk will REITs bring with it? So we should actually cap that in our portfolio. It's not going to be something that just pays us 20%. Or 80%.
It's the real estate risk. Yeah. So it's the real estate risk, it's the vacancy risk. It's not development risk, by the way, because the REIT buys a building which is fully completed and fully leased out. Yeah. And that is what it is.
So the risk of that builder being blacklisted for not handing it over is probably
not even that, because the REIT buys it completely. Okay. The risk is that the tenant goes away and you're not able to fill it up.
All right.
That is
Pankaj, investment
So
idea?
I think I'll stick to my last 5 years advice, which is very important to have an asset allocation and discipline of investments. I'm not going to be biased to go and say invest in funds or REITs or anything. It depends on an individual, what asset allocation suits you depending on your outcome, what you want to reach.
All right. Narendra, very quickly, we have about 30 seconds before we wrap up. One investment idea for all of our viewers.
No, this budget has presented a great opportunity. Keep an eye on this retirement savings option being created and get at it, because this is something which is over and above your ATC, and this will be a long-term forced accumulation of a great transparent, of a great design. So keep an eye on this and get started with it as soon as possible, as soon as it becomes possible.
All right, so my tip to all of you watching at home right now is to get a financial planner. Get a good, solid financial planner like you would a family doctor, and have him look at everything and then plan based on what you need the money for and what your goals are. Stay invested, of course, and stay with ET Now. Thank you so much for watching. Gentlemen, thank you so much for joining us. Narendra in Delhi, audience in the studio, thanks for watching.